In this video, we're going to discuss about the key details on financial statements that are available in the annual report. We have already covered most of the other parts which are there in the annual report. This now forms the final important part in the puzzle of analyzing a company. And when we look at data, these are audited financial statements that are available in the financial about the financials of the company. What do we mean by audited financial statements is that the company prepares the accounts and then gets them sort of audited, or in common language verified, by an independent auditor. Right, all companies need to do that, all listed entities need to do that. Once the auditor gives the comments is when these are essentially published. So if you are not following certain accounting practices that you should, technically the auditor, the independent auditor, needs to point that out to the company, right? So a company will prepare the financial statements. If something is not correct or something is not correctly put in, then in those cases the auditor might step in and come and try and take a look at how the statements are progressing, and why have they been prepared the certain way, and if there are certain changes based on best practices, what should be done. The auditor's responsibility is to come and tell the company that, look, this is not done correctly, you need to add correct data points to the financial statements. So that's about financial statements. Some more interesting parts that we need to understand now at this stage is essentially what is standalone and what is consolidated, and how do we really go about looking at this broad premise of standalone company versus consolidated company. So let's turn our attention first to this standalone versus consolidated debate, and then we move ahead looking at, let's say, the financial statements in our sample annual reports that we were looking at. Right now, when a company holds a stake in another business, the purpose could be for achieving significant benefits in terms of higher revenues, in terms of lower costs, in terms of access to resources, in terms of just simple diversification, right? So if company A holds a stake in company B, business A holds a stake in business B, that's possibly because business B is in a different geography. It's possibly because business B has access to raw materials that business A needs, right? So a steel company could go and get in touch with, let's say, an iron ore company, right? So essentially, and they can buy a stake there so that they have access to raw materials, access to other resources like, let's say, freight channels or logistics or marketing channels, right? So for example, you could go and buy a stake in another company where you think that could help you generate new leads to your business, right? So that could be a possibility. And it could be simple plain diversification, that you're in a business A and you want a completely different business, and hence you go and buy a stake in that particular business, right? Now, once you have a stake in another company, depending on how much stake do you have, the financial statements will get adjusted, right? This is where we come to the data around consolidated versus standalone. Now, simple terms, let's say business A holds stake in business B. So that's A, that's B, that's, let's say, C, and let's say D. If business A holds, let's say, 100% of business B, which means business A is 100% owner of business B, holds 60% in business C, and holds 20% in business D. You can do that. You can go and buy the shares from the market. So for business B, they went and bought all the shares. For business C, they went and bought 60% of the shares. For business D, they just invested 20% into the company, right? In terms of definition of subsidiaries, in terms of definition of something that is a subsidiary, you need to have significant and managing control, which is always greater than 50%. So any company in which you have a stake of greater than 50% will be a subsidiary. In this case, company B will be a subsidiary, company C will be a subsidiary. When you consolidate the statements, the standalone statements will only include A. This is the standalone bit, right? And the consolidated, on the other hand, would include all the subsidiaries as well, right? So we'll use a different color. Your consolidated statements will include the statements of these companies, and these are combined and given, right? So for simplistic purposes, let's assume that at this point of time, these are kind of pro rata. What do we mean by pro rata? 100% of B and 60% of C will be added to A's financial statements, and that is given out as a consolidated statement. So this part is consolidated, and only A, which was this, was standalone or the parent company. Now A becomes the parent company because A holds a stake in B and C. Correct? So that's the broad differentiation in terms of how do you report a standalone statement, how do you, and versus how do you prepare a consolidated statement and show that, right? So consolidated statement, and how do you show that? Now, the principles of consolidation are at this point a little bit beyond the scope of what we are doing. That's a hardcore accounting kind of a job, but we will touch upon specifics of consolidations as we go along, right? Just as we are there, let's try and understand how do you represent various stakes in common parlance. How do you talk about various stakes of a company, right? If you have a stake that is greater than 50%, you have complete control over the operations of the company because you are a majority shareholder. No one else can have a stake more than you in this company. And by virtue, this company becomes a subsidiary. This will be included directly in terms of addition in consolidated statements, right? In consolidated statements, you will include this part. Whereas on the other hand, if you have a stake of 20 to 50%, you have a significant control, but you are typically called as an associate. You might still be running the show. You might still have the highest amount of stake because let's say you have 40% stake and no one else has 40% stake. So you might still be running the show there, but it's not consolidated in the financial statements. When you look at consolidation of financial statements, this particular company will not appear there. And if you have a stake less than 20%, that's called as minority stake, right? Now, how do you represent these forms the crux of our discussion from here on. Broadly, when you are adding the financial statements of consolidation, you just add line by line, which means if there are two companies and one is a subsidiary of another one, subsidiary could be anything greater than 50% stake, regardless of the stake, you add 100% first of all, right? Regardless of what the stake is there, you just add 100% straight away, right? So for example, if you look at the concept of this, assume that company A holds 60% in company B, right? Now, as per principles of consolidation, you just add the statements 100%, which is you'll add this to this, you'll add this to this, you'll add all P&L to P&L, you'll add all profits to profits, sales to sales, revenues to revenues, expenses to expenses. There is no pro rata adjustment there. So even if you have a company A which has sales of 200 and company B which has sales of 100, company A might hold 60% in company B, but when you give the consolidated statements, because you have complete control, you just add the sales 100% there, right? Now that's obviously not going to be 100% correct, but that's the principle. Now, how do you adjust for the fact that they hold only 60%? They don't hold the remaining 40%, right? Let's take the example and understand it in a simple format. If I take the assets of these two companies and I create the consolidated balance sheet, in the consolidated balance sheet, the assets would appear as 250. However, Let's assume you sell this company today. You sell this entire company today in the consolidated setup. When you sell it, you will receive 200 for these assets. That's yours because that's the company that is there. Company A will get this entire 200 because they own this asset, right? Out of this 50, they'll get 50 surely. When they sell these assets in the consolidated setup, they will get 250. But out of this 50, only 60% or 30 is for company A, right? Only 50% or 60% or 30 is for company A. The rest is not for company A, right? Now that's going to create a problem, right? Or in other words, the remaining 20, the remaining 20 has to be paid to whoever holds that 40% stake in B, correct? If A holds 60% in B and C holds 40% in B, subsidiary wise consolidation will happen of A and B. But this 20 crore, this remaining 20 crore out of the total asset size of 50, which is 40% of 50, has to be paid to C if and when this company gets sold, right? Now, that is where on the liability side, you show it in a slightly different format. So to account for this 20 and the fact that it has to be paid out to someone else, that's a liability. If it is to be paid out to someone else, that's a liability. On the liabilities side, you will prepare something called as a minority interest. So you find the statement minority interest somewhere. That's basically someone else holding a stake in your subsidiary. Someone else holding a minority stake in your subsidiary. That 20 will come here. So when you sell the assets for 250, this will tell you that this 20 has to go to someone else. It is not yours, it is someone else's, right? That's how minority interest gets adjusted in financial statement. When we look at this in more detail, we will also try and look at this in the context of Eicher Motors because they have a subsidiary. It might be useful for us to kind of look at this data and understand if this kind of an adjustment is happening somewhere else as well, right? So let's look at Eicher Motors and let's look at them as an example to understand standalone statements first, and then to understand financial statements of consolidated entities after that, right? So if we look at Eicher Motors, that is their standalone statements, right? So standalone balance sheet, which will be followed by standalone P&L, right? Now, when you look at the standalone balance sheet, that's your standard mechanism of how do you build your balance sheet in accounting terms. That's equity and liabilities on one side and assets just below that. You will note that the terms will match eventually. You have shareholder equity. So this is what is the shareholders get. You have long-term liabilities. We'll look at individual terms at a later point of time, but typically loans or borrowings or any kind of provisions for the long term. And then you have short-term liabilities, which are given here, which could be short-term borrowings, which could be trade payables, which is what you owe to someone else, some other current liabilities, and some short-term provisions, right? Similarly, on the asset side, you first have long-term assets, right? Long-term assets are all these, which are called as non-current assets, in which you could have fixed assets, in which you could have non-current investments, long-term assets that you have created otherwise, right? And then you have short-term assets, which are represented here, which could be inventories, which could be investments on the shorter period. Typically, your short-term is less than 1 year. That's the technical definition of short term. That may or may not apply in all cases, depends on sometimes how businesses classify them. But largely 99% of the times that'll be what short term would mean. Long term is anything greater than 1 year that would come as per technical definitions, right? That's how you kind of give out the statements. There are some other points here which we will discuss as we go along, but broadly that's the first part of our understanding, that we have all balance sheets that will appear in annual reports will have the same format. So you'll have shareholder funds, you'll have long-term liabilities, you'll have short-term liabilities, long-term assets, short-term assets, and that's the broad description of what you see there, right? Now, the profit and loss statement, on the other hand, is also kind of similar. If you look at this, you first have revenues, which are given here. So your gross revenue minus any kind of duties that you have paid. Here we have referred to something as excise duty. What is excise duty? When you are a producing company, whatever you pay right on the factory gate, as soon as you produce, there is a tax or a duty on that production. That's called excise duty. Net of that, you get revenues, and then there is other income. Other income is any income that is non-operational in nature. For example, if you hold bank account balances, you might get some interest there. That's a part of your other income, right? Then you have all the expenses. This is the part of all expenses that the company has. Finally, you have profit before tax, and then you have some sort of a tax expense that comes in, right? And then finally, you get the net profit for the year, which is available to be given to the shareholders, right? All companies will have similar structures. The headers of expenses could change. So for example, if this is a manufacturing company, you will have cost of raw materials coming in. But if this is a services company, let's say an information technology kind of a company, there is no raw material, right? So in those cases, the statements might change a little bit, but broadly the structure of the statements will look exactly similar, right? We will again look at individual items in both the balance sheets. So for example, there are things like other long-term liabilities, there are things like short-term provisions and long-term provisions. We will understand this in a subsequent session, but at this point of time, the structure of the balance sheet is what is more important for us, right? Then we have what is called as the consolidated balance sheet. Now, when you look at the consolidated balance sheet, this will typically follow your standalone balance sheet. So this is following standalone statements. Usually, when you look at the annual report, first you will get the standalone statements and then you will get the consolidated statements, right? Now, when you look at consolidated statements, rest of the stuff is same. You will see this is shareholder stuff, right? You see one small header added here. This is what we were discussing. This is the minority interest. So effectively, if you have a subsidiary in which you own less than 100% stake, this is the part that someone else owns in that company. This is the worth of what someone else owns in that company, because when you added the assets, you just added 100% of the assets. So what is not yours has to be demonstrated in the consolidated balance sheet. If you see minority interest, so if you see minority interest, that means two things. One, this is a consolidated statements. Two, there is some subsidiary in your business where you own less than 100%. If you own 100% in a company, that's called as, if you own 100% in a subsidiary, that's known as a wholly owned subsidiary. In this case, you have a subsidiary which is not wholly owned. It is less than 100% that you have. Rest of the structure is same: non-current liabilities, current liabilities, non-current assets or long-term assets, and short-term assets is all that is there in the annual report. What is the only difference is that if you see a number like minority interest, one, the statements are consolidated statements. Two, there is some subsidiary where you hold less than 100% stake. In fact, even this information is available in the annual report. When we look at the annual report in detail, we will get a sense of where the subsidiaries are, what those subsidiaries are, right? So that's the minority interest number that we see. That's how a consolidated balance sheet will look. Let's try and understand that if we were adding 100% of sales and expenses as well, then that's not the correct addition as well, right? Technically, 40%, if you own 60% in a company, 40% of the profit of this company is someone else's, right? Let's go back to our example. We said A owns, let's say, 60% in B, and C owns the remaining 40%. When you consolidate, you just add 100% straight away. From this, let's say B made a profit of 100 rupees. 40 rupees is not entitlement to A, but when you added the income, you just added line by line. When you added the expenses, you just added line by line. So you've essentially added 100 and you will end up getting to 100 when you reach to profit after tax. After that, you deduct the share of the other company, of other stakeholders, right? Once you deduct this, what is left is the profit for the year. So in this case, 701 crore was the profit. From that, you deducted 86 crore. What is left is 615 crore. That is what is available for appropriation. This 86 crore was the profit that was not Eicher Motors. That was the other subsidiary, other company that held a stake in their subsidiary, a minor stake, a minority stake in their subsidiary. That's how you adjust for the minority interest here as well. So simple words, if company A has profits of 100, company B has profits of 50, and A owns 60% here. First, when you consolidate, you will get profits of 150. From that, you will remove minority interest. It will be 40% of 50, which is 20, and what is left is the final profit for the shareholders of company A is 130. That's how the adjustment for minority interest gets done. Correct? Now there are some other things that are there. You see that all across this balance sheet, there are some notes that are given, some numbers that are written here, right? That's a note number that is given here, right? Even if you look earlier, there are some note numbers that are given here. Now, what are these note numbers? Again, in broad detail, you look even in the P&L, you have some note numbers that are given here, right? Practically in front of every header. What are these note numbers? These are details of each of these line items, right? Remember we said long-term borrowings or short-term borrowings. You have a small note number 7 here in front of short-term borrowings that will tell you where have these borrowings come from, right? If you look at short-term provisions, there is this note number 10 here that will tell you what are these provisions, right? We'll take an example and look at some of those as well. But broadly, in addition to financial statements, before and after, there are some other data points which are available. What are these data points? First data point is before the financial statement, you find auditors' comments on the financial statements. The statements are supposed to be to be audited, and the auditors' comments talking about what is the firm doing and are the statements correct are what are mentioned here before the financial statements. Note the term before the financial statements, you will find the auditor statements. Statements around major accounting policies. How do you calculate revenue? When do you calculate revenue? How do you calculate depreciation? What are the policies around that? How do you look at inventories? All these policies are given just after the financial statements. So if you want to read about a company and understand how exactly did they calculate their revenue, then you can find this out here. Now it's easy in a company like Eicher Motors because they are making a bike and selling that bike, so it's easier to understand what is revenue. But if you have, let's say, a infrastructure company, right? That is, or a real estate company that is constructing a flat or an apartment. When do you consider the revenue? When you start building the apartment or when you hand over the keys or somewhere in between, right? So that is what becomes important in some of the companies. So you need to read that if the company's mechanism of reporting revenues is not very clear. And finally, those numbers that we saw, those are notes or schedules to accounts. These are details of the numbers given in the statements. For example, if the balance sheet talks about long-term borrowings, then what these borrowings are and whether they are taken from banks or other entities is all mentioned in the notes, right? These are also mentioned after the financial statements. right? That's the importance of financial statements. Let's now look at our company iShares in case and try and gauge how do they give their statements. So that's iShares Motors for us. Around page number 40, you see balance sheet as on December 31st. You see all these shareholder funds and you have these note numbers. The notes will have details. Just before this, if you look at it, if we go to the previous pages, you start with financial statements, and on page number 37 you will have independent auditors report to the members of iShares shareholders. So reports on financial statements, auditors responsibility, management's responsibility. What are their comments on this? Opinions. Usually they say that they have usually, in our opinion and best to our information, the aforesaid financial statements give the information required in a manner so required and give a true and fair view in conformity with the accounting practices or principles generally accepted in India, right? So the auditor says that all the policies that the company has followed are in accordance or conforming to the accounting principles in India. There is no discrepancy there. So these are the auditor statements, and then there are some specific data about inventories, fixed assets. At this juncture, we don't necessarily need to get into the details of all this. We'll come to this at a later point, trying and understanding whether it makes sense to look at these in details, right? Then follows the balance sheet, followed by the profit and loss statement of the company. Further, following the cash flow statement is also available. This is what we did not see earlier in our presentation, but the cash flow for the year, the amount of cash coming in and cash going out, is also available here. You will note that this is divided in three parts as we had seen earlier: cash flow from operating activities, cash flow from investing activities, and finally cash flow from financing activities. Following this, you will see the components which is notes forming the financial statements. Note 1 is typically what is significant accounting policies, right? At this juncture, again, we will not get into too much detail here, but what is the basis of accounting? Have they used estimates anywhere? How do they look at inventory? So they are saying that inventories are valued at lower of cost and moving weighted average price and net realizable value, right? So all these data points are kind of given here. How has the depreciation been accounted for? So straight line method, typically as prescribed by the accounting principles. Revenue recognition: sales are recognized net of returns and trade discounts on transfer of significant risks and rewards of ownership to the buyer, which is generally coinciding with the dispatch of goods to customers. So when a bike is sold, as soon as the bike is sold, that is where the revenue is recognized, right? And so on and so forth. You find some of these data points coming here, and then you have all the other details. Remember those notes? We said note 2, share capital. What is the share capital? Number of shares that are existing. What are the reserves in the company that the company has, that follow on subsequent pages. Then we were talking about fixed assets. So fixed assets will tell you what is land, what is building, what is plant and equipment, furniture, fixtures. All these details are essentially available in the notes to accounts, right? We will look at this again in more detail as we go along. Similarly, when you go ahead, you will look at revenue from operations, right? So how much in the standalone entity came from two-wheelers and how much came from spare parts and other components is available here. Subsequent to this, you have cost of raw materials, etc., etc., etc. All these data points are available in various notes. There are about a whole detailed 40-50 set of notes, post which they talk about what are the subsidiary companies. Right now, you look at the subsidiary companies, they have multiple subsidiaries, but the biggest one is Volvo Eicher Commercial Vehicles Limited. That's a 54.4% subsidiary of Eicher Motors. When you consolidate, you just add 100%. The minority interest part is for the remaining 45.6%, right? That is the minority interest of Volvo in that entity. The other subsidiaries are 100% subsidiary, 100% subsidiary, 100% subsidiary, and 100% subsidiary. This data is available for all the subsidiaries just before the consolidated statements. Then you move to consolidated financial statements. Almost an exactly similar idea is available, description is available. First, you have an independent auditor's report, followed by the actual financial statements, followed by the notes to accounts, notes forming the basis of consolidated accounts. Basis of consolidation is given first, and then details are given after that in terms of significant accounting policies, and details on individual line items are given here, right? So how much of the loan is from bank and how much is from other unsecured entities, that's available here. Here in this case, there is no unsecured short-term loan from the bank in the current year, right? And so on and so forth. That's the detailed part around what a company has in terms of its subsidiaries and in terms of its consolidated financial statements. At a later point of time, we're going to look at this in much more detail, look at individual items and understand what those items are with respect to a company like Eicher Motors. That's it in this particular section.